Hello, welcome to the Global Economic Trends. In this podcast, we delve into the topic of stagflation in Europe and explore its potential implications for the future. In the second half of 2020, after the economic freeze caused by the pandemic ended in the spring, the economy began to recover without hiccups. This trend was widely expected to continue into 2021. A similarly upbeat view of the business cycle was reflected in the consensus forecast. Despite production rising steadily in the second half of 2020 in line with fiscal policy's subdued demand, supply-side bottlenecks in global supply chains and logistics systems became apparent in early 2021. Borders, transportation, and production were closed to control COVID-19. Additionally, it reflects the numerous disruptions, especially in East Asia, brought on by lockdowns based on zero-COVID strategies. Now, we will explore whether the increase in inflation is a transient occurrence or if it is likely to persist in the foreseeable future. The recovery is a positive sign because it is demand-driven, following a long period of decreased demand prior to the debt crisis in the Eurozone. The European Central Bank had trouble reaching its inflation target due to the low inflation environment, which is a direct result of weak consumer demand. According to the most recent inflation data, which is based on preliminary estimates for the entire Eurozone and Germany in December 2021, consumer prices rose by 5.3% and 5.0%, respectively. Since the recovery in aggregate demand is accompanied by supply-side frictions, which create a conflict of objectives for central banks and may create the risk of stagflation, the return of inflation cannot be interpreted as a good sign. Monetary policy can mitigate inflation due to demand shocks by dampening aggregate demand, but it cannot do the same for inflation due to supply shocks because of its inability to reduce supply-side frictions. Although central banks can respond to short-term supply shocks with a wait-and-see approach, a longer-lasting supply shock could threaten the European Central Bank's ability to meet its inflation target, forcing it to slow economic growth in order to mitigate inflationary dynamics. It is therefore important to assess the persistence of the current supply shock. The data suggests that inflation rates may stay high for a while. All goods and services, including clothing, vehicles, and restaurant services, have increased in price. The Atlanta Fed Sticky Price and Flexible Price Consumer Price Indices measure inflation persistence. This index can also be applied to the price data of other countries. In Germany's CPI basket, for instance, goods and services with sticky prices account for roughly 58%. The growth rate for these categories of goods has been hovering around or slightly above 1% for quite some time, but in November 2021, prices increased by 3.5%. Increases in the sticky price indicators signal a potentially serious threat of future inflation rates remaining high. Because of its size and importance, Germany's economy has a significant impact on EU inflation dynamics. The current higher inflation rates are largely the result of a number of one-off factors, such as the reversal of the temporary reduction in Germany's value-added tax rate that applied in the second half of 2020. This will be reflected in Germany's inflation rate for the final 6 months of 2021 after the tax rate was reverted on January 1, 2021. The household sector's balance sheet situation has improved thanks to the high savings brought on by the lockdowns, increasing willingness to pay for vacations and leisure activities, making it easier to push through price increases in these areas. Consumption may have only caught up in 2021, and some of the 2020 savings stemming from the pandemic will likely have been invested in the stock market instead of being spent in 2021 and 2022. Countries in the Eurozone where personal savings have grown will also feel this impact. In response to recent and ongoing abnormally high price increases, those who have been sounding the alarm about the possibility of sustained inflation have raised their voices. Concern has been raised over shifting inflation expectations. This is coupled with concerns over an economic downturn, which has reintroduced the term stagflation to the public lexicon after an absence of several decades. The Frankfurter Allgemeine Zeitung reported, Germany is facing stagflation, on October 26, 2021. At the start of the year, inflation is rising in the US and other advanced economies, and growth is slowing. The term stagflation refers to a situation in which growth slows but inflationary pressures remain constant over an extended period of time. This was the result of a build-up to higher inflation rates, the unexpected inflation caused by the 1973 oil shortage, and the accelerated structural change under the banner of automation in the 1970s, the decade of stagflation. While some similarities exist between the present and the past, there are also key differences. Given the state of the economy at the time, the wage and financial policies of the 1970s were too generous. While getting used to the new monetary system that emerged after the fall of Bretton Woods, central banks had to establish a solid reputation for their work in the fight against inflation. The realization that cheaper goods wouldn't eliminate inflation or unemployment eventually won out. In the decades following 1980, the pace of globalization quickened and international capital flows were liberalized. As a result, there were new opportunities for growth. Cost advantages and market integration in highly competitive markets have allowed prices to keep going down, which is good for consumers. When figuring out how risky the current stagflation scenario is, you have to look at both the growth outlook for the next few years and the long-term effects of inflation. Both settings are impacted by decarbonization because, in addition to the CO2 prices effects, it can also cause excessive demands on businesses during times of structural change. The rate of structural change is already fast, and things like the digital transformation, which threatens to shake up business models, are speeding it up. Given the current state of the world's economies and the escalating conflict between competing global systems, it's unlikely that the global division of labor will ever lead to a reduction in inflation or a speeding up of economic growth. Now we explore the intricate relationship between international trade and pandemics. Although many industries and sectors have experienced delivery and performance delays due to supply-side frictions, the automotive industry has experienced a particularly severe setback. However, the outlook for economic growth in 2022 and beyond remains positive. Although some supply bottlenecks, like those in the semiconductor industry, may be here to stay for the foreseeable future, proponents of this view argue that overall demand is healthy and growing around the world. This is due, in no small part, to the rapid stabilization of employment and the reemergence of skill shortages, as well as the emerging trend that many people with medium and lower skills have sought and found other jobs during the pandemic, or are only now returning from short-term work. Not only that, but the restrictions at Asian ports will keep container prices high and cause shortages of essential raw materials and inputs. For instance, from 2020 to 2021, the cost of essential raw materials like alumina, aluminum, cobalt, and tin all increased by more than 50%. As crude oil prices rise, downstream products like benzene, polypropylene, and polyvinyl chloride cost over 50% more. Furthermore, the cost of an essential component of the auto industry, urea, has increased by 46%. Cotton and cotton yarn have also seen relatively large price increases, which are currently reflected in the textile price increase. And considering the ongoing debate over nuclear power's place in a climate-friendly energy mix, the price of uranium has risen by 65%. High retail prices are already being felt by shoppers as a result of the shortage of microchips. For instance, after years of steadily decreasing prices when factoring in quality, the cost of computers and smartphones has recently increased dramatically. Price increases for these items are having a significant impact on inflation at the moment because they have historically contributed a disproportionately large amount to depressing inflation rates in recent years. The chip shortage is having a ripple effect on the automotive industry as well. The final consumer is paying a significantly higher price in this area as well. Whenever there is a revival in cross-border commerce, these conditions will revert to normal. Even though friction is still expected in the first half of this year, price increases are expected to last well into 2022. Moving to understanding the relationship between price inflation and the energy market. In addition, the aftermath will be felt throughout much of the year 2022. For instance, oil supply has been cut as a result of the lockdown in the first quarter of 2021, and it has not yet adjusted sufficiently with demand returning to normal in the summer of 2021, causing significant price reactions. Whale availability was 8.4% lower than it had been before the crisis in September 2021. It now appears that oil production will resume its pre-crisis level by February 2022. If oil production doesn't pick up, prices will continue to rise until December 2022, when they will have returned to pre-crisis levels. There are constraints on the availability of gas due to a lack of storage facilities. The harsh winter of 2020 to 2021 has caused storage levels to drop 22.1% from the previous year. Conversely, gas demand for heating increased in November 2021 over November 2020 due to the colder start to the month. If this winter is particularly cold and gas storage is severely depleted, then the high price of gasoline is likely to persist throughout the rest of the season and into next year. Temperature rises, however, may mitigate this effect. Moreover, the price of CO2 may have made gas consumption more appealing than coal, leading to an increase in gas demand. Now we shift our attention towards knowing, to what extent does the price of carbon dioxide affect inflation? Climate policy is meant to raise the price of fossil fuels, but not at the rate it is doing so now. This means that the sharp rise in energy prices is a trade-off for policymakers who want to meet their ambitious climate goals. Most people will not be able to make any drastic changes to their transportation habits in the near future, and few will be able to immediately switch to a heating system that uses less polluting fuel. The credibility of climate policy would be damaged if Germany's €25 per ton CO2 price on energy fuels and motor fuels were suspended or reduced. For this reason, it would be preferable to ease social hardship through measures like temporary adjustments to housing allowances or higher deductions for mobility costs for commuters. And the burden of high electricity bills for consumers may be lifted sooner than anticipated. An increased incentive to switch to electricity, which is becoming a more climate-friendly energy source, could be achieved through a quicker reduction or outright elimination of the German renewable energy surcharge. The long-term goal of climate neutrality necessitates that CO2 pricing be reflected in consumer prices. Households as a whole are responsible for about a quarter of the world's annual CO2 emissions, or 232.5 billion metric tons. Every month, the typical German home uses about 0.2 metric tons of CO2 in the form of electricity, gas, and fuel. Food consumption, travel, and mobility each contribute a smaller amount of monthly emissions, at 0.04 metric tons, 0.03 metric tons, and 0.04 metric tons, respectively. Starting in 2020, the cost of carbon dioxide will rise until it reaches €55 in 2025. A methodology for estimating these impacts on the cost of living has been developed by Prus in 2019 and No in 2020. The average family's CO2 output is priced at this point in time. After that, the sample income and spending data can be used to check how accurate these numbers are in terms of consumer spending. These numbers suggest that if the full cost of the CO2 tax is passed on to consumers, the cost of living in Germany will rise by 0.172% in 2020 and by 0.34% in the following years. As the price of carbon dioxide rises, so too will the cost of living in 2022 and 2023 be by 0.03% and 0.05%, respectively. These projections are only estimates, but they do show that inflation is likely to rise structurally, which could pose a problem for monetary policy. This is because a restrained response from monetary policy to these initial effects would be inappropriate. Companies that rely primarily on activities not classified as sustainable in the EU taxonomy on sustainable financing will face higher financing costs, further driving the transition to a more sustainable corporate sector. It will take time for businesses to become environmentally friendly, and in the meantime, financing costs for CO2-intensive businesses are expected to rise, leading to price-pushing inflation. Causes of inflation as a result of the labor market. Germany's use of temporary work arrangements during the 2008 financial crisis was exemplary, and similar arrangements were implemented on a European scale during the COVID-19 crisis. The employment market's influence on inflation might have been mitigated by using temporary workers. Temporary work reduces the need for companies to lay off workers during a recession, and it also helps them save money on hiring when the economy begins to improve. A possible explanation for the disparate reactions of the labor market in the United States and Europe to the COVID-19 pandemic is the use of temporary work schemes in the former. When the US unemployment rate skyrocketed, the European rate rose slightly, much less than it had during the global financial crisis and the European sovereign debt crisis. Competition between employers for new workers could push up wages, especially in labor market segments where skill shortages are typical if short-term work schemes were not in place during the recovery phase. There is a risk that businesses will respond to wage increases by raising prices to cover the cost of hiring and paying workers a living wage. As a secondary effect, higher wages allow workers to increase their demand, leading to higher inflation, which then prompts workers to demand higher wages to offset the impact of the inflation on their purchasing power. Although a wage price spiral's emergence cannot be ruled out for the months ahead, the labor cost indicators do not currently support its emergence. As only about 3% of private sector workers in the Eurozone have their wages, and minimum wages automatically index to inflation, economists believe wage indexation schemes have a negligible impact on inflation. Furthermore, they claim that roughly 18% of Eurozone workers participate in indexation schemes that formally factor inflation developments into wage negotiations, and that these schemes take into account mostly forward-looking inflation measures that exclude energy. The study's authors conclude that wage-setting schemes do not significantly contribute to the onset of secondary effects, particularly concerning energy price increases. Possible alternation brought on by long-term effects of rising CO2 price on inflation and real income. In order to reduce emissions, the price of carbon dioxide will increase at a faster rate in the coming decades. The extent of the macroeconomic impact will depend on the collateral effects along the value chain. Large-scale price signals are needed to initiate the transition to climate neutrality. Price effects will become less significant for the economy as a whole as the adjustment continues, but this is not expected to happen for at least 5 to 10 years. To avoid a wage price spiral, policymakers should recognize that the transition to climate neutrality will have real income effects and that it is not the job of wage policy to offset these effects. Policies compensating low and middle-income households are necessary to prevent resurgence of the old conflict between wage and monetary policy. The continued aging of Western societies poses a new threat to growth and inflation over the medium term. In the medium term, societal age weakens potential growth by decreasing productivity. Productivity increases don't just benefit the economy as a whole. They also help make products and services more competitively priced. The pricing power of businesses declines in tandem with a general decline in productivity. For the time being, it is unrealistic to assume that wage policy will once again be characterized by increased wage settlements or even accelerated wage growth. Historically, price peaks were followed by wage peaks without any drastic time lag effects becoming apparent. Scarcity premiums will encourage the substitution of digital alternatives for routine office tasks. Although the empirical literature on automation's effects is mixed, it's safe to assume that it hurts workers' pay. It's possible, too, that employees' altered status as a result of labor shortages is reflected not in wages but in other aspects of employment, such as more flexible schedules. In the case of structural change, however, workers may prioritize job security over wage increases because a higher likelihood of continued employment traces the discounted sum of future wage payments. With the savings from lower wages, businesses have more capital to invest in adapting to structural shifts, which ensures workers' continued employment. We will now delve into the reasons about decreased efficiency in production. Since the 1960s, there has been a gradual slowing in the rates of increase for labor productivity, capital intensity, total factor productivity, and GDP per capita figure 4. These figures represent a midpoint over 10 years in 23 countries. Per capita GDP increased at 4.2% per year in the 1960s, but this rate has slowed to 1.1% from 2011 to 2020. Compared to the preceding period, annual growth rates in both labor productivity 4.7% and total factor productivity 3.1% have slowed to 0.8% and 0.5%, respectively. Capital intensity has also decreased from 5% to 5%. A decrease in productivity growth has two results for price increases, according to Yellen in 2005. The first consequence is increased business costs due to the increased unit labor costs that businesses would incur. Even though workers are willing to take a pay cut to offset slower productivity growth, she maintains that there is still an adjustment period with upward inflation pressure. The second effect is a deceleration in the expansion of total demand, which could mitigate the impact of the productivity slowdown on price levels. If inflation rates worldwide have been going down, this could suggest that the second effect has been more substantial than the first. As a growing number of governments and central banks adopt an inflation targeting strategy, the proportion of countries with high inflation has fallen. In contrast, the proportion of those with low inflation has grown. Household indebtedness rose in the years leading up to the 2008 financial crisis and the subsequent banking and sovereign debt crisis in the Eurozone. Households were compelled to deleverage after the two financial problems, which resulted in a lack of aggregate demand and, in turn, subdued price growth over a long period. Despite households' better financial standing going into the COVID-19 pandemic, the outbreak and the ensuing lockdown measures have caused a delay in consumption spending. As a result, people started saving more money, and household finances improved even more. As a result, households with healthy finances should have robust consumption after the pandemic. Higher inflation and low growth, also known as stagflation, can be expected in a scenario characterized by slow productivity growth, rising energy prices, and rising labor costs. Do U.S. central banks need a trade-off for new macroeconomic policy? Let's explore. Overall, stagflation is a possibility. The long-term drivers of higher inflation and weaker growth will affect Germany and Europe. There is deglobalization, rising protectionism, balkanization, and reshoring of global supply chains, as well as the demographic aging of advanced economies and key emerging markets. While persistent adverse supply shocks threaten potential growth, loose monetary and fiscal policies could de-anchor inflation expectations. The wage price spiral would cause medium-term stagflation worse than in the 1970s when debt-to-GDP ratios were lower. The medium-term risk of a stagflationary debt crisis will remain. A central bank must raise interest rates to respond to an inflationary demand shock, but a supply shock conflicts with that goal. The supply shock has already slowed growth, so increasing interest rates to fight inflation would further reduce it. Lower interest rates cannot resolve supply constraints. It would boost demand and inflation. Thus, Eurozone key interest rates are likely to stay the same this year or next. Eurozone net purchases under the Pandemic Emergency Purchase Program will likely drop to zero, meaning only expiring bonds will be replaced. If financial markets are liquid, this is possible. However, since the global financial crisis, the capital markets have been risk-averse to bad news, which can cause a sudden withdrawal of capital and a spread increase. Unfavorable news about a country's or major financial institution's financial stability would cause this. Thus, financing conditions should remain favorable, improving the economy. This will not reduce trade and commodity market friction. Therefore, we anticipate expansionary monetary policy and higher inflation this year. In the second half of 2022, Eurozone inflation should gradually rise to the ECB's 2% target. U.S. Federal Reserve System balance sheets are expected to shrink in the coming months. The Fed will raise rates then. After the global financial crisis, it had success with this sequence. The US's higher demand and overheating risks from the economic stimulus and infrastructure programs explain the Fed's interest rate hikes. Due to logistics issues, the expected euro devaluation may not boost foreign trade. The risk of stagflation in the coming years necessitates an outdated macroeconomic policy design. The wage monetary policy conflict seemed resolved. Falling unemployment no longer raised unit labor costs. That may change now. Macroeconomic challenges to financial policy are the key. The investment policy is flexible as long as long-term government bond interest rates are below the macroeconomic dynamic. That's all for now. Thank you so much for listening. Do share the podcast, tell your peers or friends about it. In the following podcast, a new series will be unleashed, Ethics in business in the new normal.